This is the Make Planning Make Sense podcast. I'm your host, Aaron Zimmerman, and I'm a director at Centro. Our guest for this episode is Uliana Kuzmis, Chief Credit Officer at Pallas Capital. Our conversation is a window into the world of development finance. Uliana sets out how development is actually financed or not, including the functional constraints on finance that aren't easily visible to other parts of the built environment sector. It's a must listen for anyone in the sector who knows the value of knowing the full picture outside our own silos. Please give the podcast a follow on your preferred platform, recommend the show to your network, and continue the conversation on our media channels, MPMS Podcast, on Instagram, X, and Blue Sky. Here is our conversation with Uliana Kuzmis. Uliana Kuzmis, thank you so much for joining us today.
Thank you for having me.
We always like to start off with a little bit about who you are and how you came to your role.
Oh, thank you. That's a 20 years long journey.
I need every detail, please.
Oh, you do? Okay. So my current role is Chief Credit Officer and also MLRO Officer at Pallas Capital, which is a bridging and development lender recently launched into the UK market. We are a newcomer, but we are not new to the market. We're backed by quite substantial Australian non-banking lender that has been running for about 10 years. Prior to that, I was a Deputy Managing Director, Development Finance Division at Hampshire Trust Bank. I had a lovely team of 40, quite active, strong player in the market. And prior to Hampshire Trust Bank, I had a very exciting role at Octopus Real Estate, where I was head of Development Light department, where we effectively designed and launched an incredibly successful product called Development Light, which would provide development finance for loans up to 5 million.
I like the idea of development light, like a light yogurt or a light soda.
It's actually really interesting you say that, because what we thought is development finance is difficult and complicated, right?
Yeah.
And whether it's a small deal or a large deal, the level of due diligence you undertake is similar, but larger transactions are sometimes easier to underwrite. But as a lender, you need to justify the effort and the time you put into writing a deal. So we thought, why don't we create a product that is quick to go through and as painless as possible? And because those transactions are smaller, we were thinking about stripping away all the unnecessary bits, so things we can be commercial about. And that's how the light idea came to life. And that was incredibly well received by the market.
That's interesting. There's a lot of discussion about a similar approach being incorporated for minor development in the new London plan to reduce these onerous requirements on development that is not of the scale where those specific bits need to be examined in such forensic detail. It's more about just getting them up on their feet, getting them right, but maybe not fretting quite so much.
Exactly. Not everything is must-have. Some of it's nice to have. And there's so many processes in development finance or in planning, in fact, that could benefit from this approach.
I'm sure that the team drafting the new London plan is listening. Hey guys, gals, everyone, hello. To dream. But when we talk about managing the risks and ultimately securing a lender's approval, what are the risks that we're managing from the industry's perspective?
It's funny, most lenders who don't operate in development finance think or believe development finance is riskier than other areas of finance. But from my point of view, having done this for the last 20 years, I believe that development finance is de-risked because of the amount of due diligence we do when we underwrite development finance transaction. Things like fraud, for example, it's very rare to have cases of fraud in development finance purely because of the length of time we work with the borrower and the level of detail we go into with the borrower before we even complete and before we release the first tranche. And if there was a fraud built into the structure, there's a very high chance the lender will identify it. Looking at borrower's background, borrower's assets and liability statement, previous development experience, construction experience, financial strength of construction companies and the directors behind it, analyzing all the challenges and aspects related to construction costs, all of that. By the time you've finished, you have really good feel and understanding around what kind of risk these transactions carry. While when you have a bridging and you get your inquiry on Monday and you complete it on Friday, yes, there is an asset there, but the speed is scary. And there are chances that you might miss something in the process. And obviously the risk of fraud is much higher in bridging. And this is actually becoming a big problem those days for lenders.
At what point do lenders tend to get involved? There's a lot of money that goes into a planning application, for example. It could easily be £500,000 for a major development. Are planning costs often incorporated into the sorts of financing that Pallas performs, or is it more industry standard for lenders to come in at a later stage?
So planning costs play a quite important role in viability assessments. We would typically see those transactions once planning is in place, simply because if you're presented with a deal prior to planning approval, it's so speculative. It's almost impossible for us to foresee where it might go, what kind of conditions you might get, especially Section 106, Section 278, all sorts of obligations, seal obligations. It's almost impossible to calculate, and they can sway transaction one way or another. But once the planning permission is obtained, and when the transaction comes for assessment by the lender, we would take into account planning costs, because those are the hard cost, hard cash that the borrower has put into the transaction. And what it allows us to do, it allows us to increase the loan amount from loan to cost perspective by acknowledging this hard cash in a deal. Because many of those deals, when developers manage to obtain planning, those are the deals where there's a significant uplift between the purchase price and the market value. And if you don't take into account planning cost, for most lenders, loan to cost will be the restricting factor. So you're not actually able to get as much money as you could have gotten if you included planning costs. If you have done remediation works, if you have design fees, you got planning costs, you got demolition costs, definitely worth it disclosing all of those costs to the lender, because that will increase hard cash in the deal and it will allow the lender to offer more beneficial terms to the borrower.
That all makes sense, but it's quite striking that planning tends to be financed by the applicant themselves. The other thing that came out of that I heard is that acknowledgement of how much risk is involved in planning. And of course, it's my job as an agent, it's our job as planning consultants to mitigate that risk as much as possible and advise on that risk as much as possible. But you still get clients calling you up and saying, hey, I want to do this thing. That'll get planning permission, right? And you have to say, well, it's a balance of factors. And of course, it's okay for it never to be a yes or no, but the gray area is so much of that continuum from surefire to not a chance, that I can understand why capital isn't really interested in getting involved until all of that mess is over.
It's too speculative for lenders to be comfortable. Obviously, if you have an underlying asset on the side, whether it's an office building with plan B, if planning is not successful, then maybe we can tidy up the office and rent this out. There's a little bit there. But the truth is, we need a strong underlying security. We need something we can sell. And sites without planning, it's too speculative. I'm not aware of anyone funding them at present. So it's all kind of risk that is the borrower's risk. The upside, though, is quite substantial if they are successful. So, for example, I have worked with borrowers quite successfully. They buy lots of sites relatively cheap. They don't have planning. They normally cash buy them or use investors' money. And they go for planning applications for the sites, and they're quite successful. So on average, about 8 out of 10, they will be successful gaining planning. And each one of those successful applications would uplift the value of the site, sometimes by hundreds of thousands of pounds. So if they were unsuccessful with 2 out of 10 and lose a little bit of money on their sites, they're still well compensated by the successful sites. If you only have one and you put all the eggs in one basket, of course, this is very risky. But if you spread your risk overall, it's a game positive.
I guess another way to look at that might be that the financial cost of an uncertain planning system, that is a factored cost, right? But not to a lender necessarily, and not necessarily visible to planning. But for the developer, there needs to be a certain amount of the investment in planning written off just in the aggregate. I do wonder what effect that might have on the ability for new entrants in the market to emerge, because it sounds like you need to be sitting on a good deal of money to actually start that engine and to accept the risk as the developer. If you know that maybe 8 out of your 10 will pay off and 2 need to be written off entirely or substantially written off, and you do something else with the site.
100%. It is risky. And where I have seen this successfully played is when you have a strong planning consultant by your side. Hello. Hey, nice to meet you.
That's me.
And this is where the certainty of planning is the strongest driving factor. You know, you have been there, you have done it. You know how they think. You almost know who to talk to and what points to press to get that planning. This is where it works.
Yeah, that is exactly our role, to have that advice for our client to say, ooh, that's not going to fly with them. But other elements of the situation are going to resonate with them. And we can focus on those, and that ability to speak between worlds is quite interesting. It's a lot of fun. And I think that planning and finance, we coexist either sequentially or in this constellation of the sector, but there isn't always enough mutual understanding between our subsectors.
We're a bit privileged in the finance world. We get to see the outcome of your hard work, and we don't actually see what goes in it, and we benefit from the final result effectively.
Must be nice.
It is actually, yeah.
Yeah. When a lender looks at a site though, so let's imagine it has planning permission, the pre-commencement conditions have been discharged, it's well within the expiration date, or it's been lawfully implemented with certificate of lawfulness, which is actually really important. If anybody's trying to transact on a site and the seller is like, oh yeah, that's been implemented, get the certificate of lawfulness.
Yes. It can actually jeopardize finance.
You had mentioned before, Uliana, that some lenders won't even get involved until all pre-commencement conditions have been discharged. Is that in order to reduce the risk of an expiring permission?
Not necessarily, no. Discharging pre-commencement planning conditions is the right thing to do. We got to
Yes.
we got to follow the rules, we got to follow the law, and we got to discharge pre-commencement planning conditions before we actually commence on site.
Mm-hmm.
For many lenders, this is a rule. What happens on the grounds is actually very different to the ideal world. And when you start development finance application and you're probably 3-4 months away from commencing on site, you think that's a lovely amount of time to discharge those conditions. And the borrower does everything by the book, and they are fully engaged, and they submit full packages to discharge all the pre-commencement planning conditions. They do the right thing, and they do it well in advance. And then 3-4 months later, you're still sitting on those pre-commencement planning conditions that have not been discharged.
Yeah.
And sometimes you have a little bit of positive correspondence back, communication back from the planners to say, we're just too busy to, but, it looks okay. Some lenders will take a view and will allow the client to commence. Yes, it's not by the book, but if we all sat and waited for every single pre-commencement planning condition to be discharged, nothing will get built.
Yeah.
I'm aware of projects. We funded some projects where the project reached practical completion, but some of the pre-commencement conditions that was submitted 12-18 months prior to that are still outstanding.
Wow.
And it's not because there was anything wrong with the submission. It's just the council has been too busy or non-responsive. We could all follow the book and follow the rules, and the country will just stop and there will be no construction going. So sometimes you do take views. For me, what's important when considering pre-commencement conditions is A, has the client actually submitted them, and whether the quality of the submission is good, and are we delayed just because the council is overloaded? Or if they haven't even been submitted, I would not fund this transaction, I will wait. But if they have been submitted and there have been several weeks passed since, and they have good, and the submissions of good quality, come on, we got to build a home. So
yeah, the courts have said something similar. If there are outstanding pre-commencement conditions, you might be up against the timeline of an expiring permission. The council hasn't given you any sort of evidence that those submission materials are inadequate. It may be possible to lawfully implement the permission before its expiration, even if those pre-commencement conditions are not discharged. So it's not by the book, but in a way, through common law, there's been sort of an accretion built around that. It says, actually, we kind of know this part doesn't work. And so we need to acknowledge that you don't lose this entire planning permission just because the consultee is not getting back to you. But also, we're not giving legal advice. When you are dealing with a matter of law, it's really helpful to get a planning solicitor on board.
that's good.
Yeah.
Aaron, also, you may want to tell us a little bit more about deemed discharged. I think that's a brilliant idea.
Deemed discharge is so fun.
Okay,
right?
tell us.
Oh, first of all, let me say deemed discharge is great because it's nice to have something in the procedure where it's procedurally correct to do what you kind of itch to do anyway, which is you just haven't done this. We're past the statutory determination date for this condition. We're going to issue a deemed discharge notice. And if the council doesn't take action then to determine the discharge of condition application one way or another within a certain number of days, then the condition is deemed to be discharged. If you just don't hear back, then you should be able to say,
It's
all
approved.
right. A good number of permitted development rights actually, which require prior approval, also have a fixed time limit whereby if the council doesn't determine it within 56 days, then it is deemed to be approved.
Yes, but lenders would often want to see the actual approval.
Yeah.
Rather than approval by default, because we don't know whether the submission itself was lawful, whether the project itself was entitled for such submission.
Yeah.
But yes, I agree with you. Deemed discharge is a wonderful concept. I have only recently discovered this. And when the borrower told me about this idea of deemed discharge, I thought, I have never heard of this. How come more borrowers are not using it? And I don't think many borrowers are aware of this.
You sort of run two risks, right? The first is that the council receives that and then says, screw you then, and just refuses it, right? The other risk is that, as you say, once deemed discharge occurs, we can go back to the council and say, deemed discharge has occurred, and then nothing. And in a profession that's ultimately always built on a series of documents, I can only imagine that there's going to be a third party that says, yeah, but I need the council to say that.
It's a little bit nerve-wracking, but the council does say that. A few weeks after that, the council will issue a notice saying, yeah, we haven't responded to you within the appropriate time. We confirm we deem this as discharge.
Absolutely, it's what they should do. The risk is that if they haven't been replying and then they just still don't reply, there's always going to be somebody else in the built environment sector who needs eyes on that confirmation. I've only used it like twice. It is a really interesting sort of, and I agree, underused lever tool.
I think it's quite powerful. And until the planners resolve the workload issues, which I don't believe they ever will, if it helps moving projects forward, we should use it.
We will be right back. So managing risk, right? We've got a permission. It's been lawfully implemented. Now it's time to secure financing. Does development finance approach different kinds of permissions differently? So if there's, say, a full planning permission versus an outline planning permission versus a part full and part outline planning permission, how do they pace the release of financing and how do they structure that or even view the risk of those differently?
That's such a good question. There's a huge difference between how lenders treat full planning versus outline planning. Virtually everyone wants full planning, including Section 106 executed prior to completion. Mm-hmm. With outline planning, the liquidity is pretty much not there. It's much riskier. Those transactions are still deemed as speculative transactions, and very few lenders will support the transactions with outline planning. It's effectively, if the site benefits from outline planning, it's not a development finance proposition, then it's probably a bridge to allow the client to have reserve matters approved. But then if you're looking at planning bridges, the land with planning, whether it's outline or full planning, a land with planning is not well catered for in terms of finance. There's not much liquidity for those. Mm-hmm. And there are some structural reasons into why this is not well catered. Historically, what have happened is that the land with planning finance was treated as a bridge rather than development finance, because there's no development finance yet, there's no construction yet. But in order to assess land with planning for lending purposes, you need to have a development finance specialist in the background who would run viability on the actual project. And in many cases, when the borrower or broker comes with a land with planning transaction, they don't yet have the full visibility into the next step, the actual development of the site. And without that visibility, without full development appraisal thought through and well priced and well structured, it's almost impossible to structure the development finance exit that will then offer exit for that land with planning bridge. And in absence of that, your land with planning bridge is a shot in the dark. It's a wild guess. So
even if the outline planning permission secures a specific number of units or a minimum number of units, a specific affordable mix, you just don't have the build costs. So the permission really needs to be shovel ready for a lender to have full sight of the variables that they want to understand.
That is correct. Okay. Let's say if you have an outline planning, but most of your key reserve matters have been discharged, and maybe you have details of landscape outstanding. You obviously have got approval for majority of them, and there is minor low-risk reserve matter is outstanding. Some lenders might take view on that. The sheer fact that you are unable to commence on site until all reserve matters are approved, that practically prevents you from commencing development. And development finance requires you to commence on site. Development finance, when it's offered, the client is expected to commence within 1 month, maybe 2 months, maximum 3 months. It's a construction facility.
Yeah.
So reserve matters effectively holding you back from commencing, which means bridging is a better proposition.
I guess that helps to explain why a lot of master planned areas or phased development will take the hybrid approach and have at least a portion of it with full planning. So at least they are keeping all of their sort of flywheel spinning as they can progress.
Yes, and of course it also allows you to phase the project and allows you to release units to the market in a phased manner, which improves absorption and the saleability of the units. There's lots of benefits in using this approach. But then going back to what we just went over, bridging lenders do not have development expertise, and land with planning and funding land with planning requires development expertise. And this is where many of those transactions went wrong in the past.
Is there good liquidity in the market at the moment for schemes with full planning permission?
That's a really good question as well. The answer is no.
Oh, the real bread and butter of planning, a site with full planning permission.
Yes.
Okay, walk me through that.
The answer is no, because there's different types of land with planning. The way I think of land with planning is some of them are liquid.
I guess it might be helpful as well if you could define liquidity for the listeners.
When I think about liquidity, it's all about, if I put this asset for sale at auction, how many buyers will I have that will be interested in this site? So site for residential development, straightforward, a relatively small number of units. There will be a large group of people who will come and bid for this site. It's bread and butter. Lots of developers would want to do residential. Lots of lenders would fund residential. It's a liquid land with planning asset.
So it's more likely that if you needed to repossess a site, it could be treated effectively as a cash asset.
A relatively liquid asset that I can potentially quite easily repossess. If you look at land with planning for a development of, let's say, 20-story hotel with leisure facilities, maybe a special care, maybe educational needs facility, or maybe a religious institution or a charity or some sort of unique restricted use, the pool of buyers shrinks significantly. In the default scenario, if I had to take this site, put it at auction, if I'm lucky, I may have one person interested in it, and that person will drive the hard line with the purchase price of the site. So those sites are not liquid. And the lender's desire to fund transactions, sites like this, is significantly diminished. Having said that, when you're funding land with planning, you have two exits. One is sale, and we touched based on liquidity. So simpler sites are much easier to sell. More complex, larger transactions are harder to sell. The second exit is development finance exit. And in order to determine whether development finance is a viable exit, you need to run through the full viability assessment, full development appraisal, full calculations of exit. If I look at land with planning, I want to know whether I can take the land out. And if I can, that is almost a guaranteed yes. So liquidity is one, but very important, is development exit is a viable exit.
When you say take the land out, what do you mean?
When you structure development finance transaction, your priority is to fund construction costs. You want to have fully funded projects. The next priority is, or maybe the first priority really, is your interest. And only the leftovers, the end of the water flow, is the land loan. So the land loan in development finance deal is never a priority for a lender. The priority is the construction cost. Once the project is fully funded, then if there's anything left over in the finance pool, this leftover is going to go into the land loan. So you need to know that your land loan is big enough to fully refinance the bridge against the land with planning. If you are unable to refinance bridge against land with planning, that means development finance is not a viable exit for this borrower. I'll give you an example. I looked at a quite large transaction recently, and that transaction, the dynamic of the transaction, in particular the GDV, the number of units, the construction cost, and the length of time it takes to deliver the project, that transaction needed at least £5 million cash injection from the borrower before the development finance can kick in.
Okay.
I'll explain it in a little bit more detail because it's maybe difficult to hear without seeing the figures. But for most development finance deals, the amount of money you're going to advance to the client is driven by loan to GDV. So if my loan to GDV is 70% and I'm giving a particular GDV for the project, I would take 70% of that number, and that's the pool of money I'm capable of working with. Within this pool of money, I will prioritize interest and I will prioritize development costs. And in this scheme, there was no funds left at all to fund anything on day one, no land loan at all. And also, there wasn't enough money to even fully fund the construction costs. So in order for me to fund this, and I'm quite aggressive lender, I can go up to 70% loan to GDV, and not many lenders can do that. In order for, even for me to fund this deal, the client needed to put £5 million into the build before I step in.
Before that first release of funds.
Exactly.
Yeah.
And I wouldn't reimburse him the £5 million. I would start funding. So he would spend the £5 million. I would spend the rest. I would put the rest of the funds in. And when I'm fully drawn and the project is at practical completion, then I'm at 70% loan to GDV. How many developers do you think are out there who have the capability of putting £5 million cash in?
I mean, it goes back to that idea that there are certain financial barriers to new entrants in the market.
Exactly.
And to SMEs.
And
sure.
Also with this particular project, that's just this is a good example of land with planning, full planning, that is absolutely illiquid. Because anyone buying this piece of land will have to have £5 million in cash to put into development before they're even able to obtain development finance. That pretty much cuts out everyone on the market for this piece of land. So that's not a viable scheme.
Yeah.
The only way to make it viable is if those particular clients are able to enhance planning permission and increase that GDV, which will then allow greater development finance to come into play.
And we see a lot of that over the past few years, especially where a site has been acquired by a client. The site benefits from full planning permission, but it's not viable to build that development. And so our involvement might begin right at the start of our client's involvement where they've acquired the site and they say, okay, how can we make this more efficient? How can we push the massing envelope? How can we tweak the unit mix, the affordable offer, the S06 contributions, and just trying to get the numbers to line up with the industry expectations from their lenders. It's not a pretty picture for a bog standard development to have such low liquidity, as in it's not even competitive to attract interest from other people to build it.
That's the thing. You can have a viable planning with profit. It's a profitable site. So the site we just looked at does have a good profit. So if somebody had £5 million to put in and they were to build this, they will have profit in the deal. But unfortunately, the entry barrier is quite significant. Yeah. So you're not just looking at obtaining planning permission to create profit for the borrower, but you also want to be thinking about the finance dynamics, the development finance availability and liquidity, and you want to minimize the amount of equity injection needed from the borrower to lift this project off the ground.
What needs to change for the absence of liquidity in the market to ease?
We don't have a liquidity challenge in development finance market. As in, development finance provision is widely available. There's lots of players. There's huge variety of offering. You have your bank lenders, you have non-bank lenders, you have challengers, you have family offices. The provision of development finance is not actually a challenge. It's the challenge is where you have certain sites that are not liquid and you have limited availability of finance for land with planning. What needs to change? Lots of things needs to change. Development finance is widely available.
Okay.
Finance for land with planning isn't.
So by land with planning, we mean disposal of land with planning. It's like the sale of land that benefits from planning permission.
Yes.
So development finance, as in the ability to finance somebody who just wants to buy the land that benefits from planning permission, is very illiquid.
Correct.
The ability to loan money to actually put spades into the ground and build out a development is more liquid. It's flowing more freely.
Catered for, yes.
Okay. Who are the different players in development finance when we're looking at different types of lenders?
Based on rough numbers floating around, there are potentially more than 250, maybe even 300 lenders who offer development finance. This is a very saturated market. That's why I referenced this market as well catered for, because there's so much competition in development finance and there is also enough expertise in development finance. But if I was to break it down to groups, you would have your high street banks. They're interested in larger projects. They're typically slow. They're cheaper. The gearing might be a little bit more conservative. But if you have the time in your hands and you want cheaper finance and the project is large enough, you'll go to high street bank. If you want a bit more speed, a bit more agility, maybe a product that is slightly punchier in terms of the gearing, then you have challenger banks. They're still well priced because they're funded by deposits, but they can move a little bit faster. Your customer service is probably a little bit better. and it's a popular way of funding transactions. Then if you want to go further up the agility and the commerciality curve, you would have non-banking lenders who would potentially have a little bit more flexible funding lines. They're going to be a lot more customer focused. They're going to be moving much faster. Appetite is potentially punchier, and they might even be able to take views on all sorts of colorful aspects of transaction, things like maybe a little bit of adverse credit history, maybe first-time developers who are trying to enter the market but have never built before. So you would probably go to challenger banks or non-banking lenders for that. And then you would have family offices, smaller players who may have enough finance expertise or experience to be comfortable lending for development finance transactions. With those, it's a bit of a hit and miss because depends on what the background is. You may get a fantastic deal with ease because some of them, they don't know what they don't know. So they may not ask the right questions and they may not dig deep as others would, but they would often charge a little bit more for that. So you may have faster funding and easier funding, but it's probably more expensive relative to other options. So enough players, enough liquidity, lots of funding, lots of appetite, lots of competition between different players, lots of lenders going head to head on same deals. So good development finance transactions really can get very competitive funding available from multiple providers.
So high street banks, challenger banks, non-banking lenders, family offices, as you move down that list, is it correct that the risks that the lender may be willing to accept or not know that they're accepting and the interest rates that they would likely be charging within their sort of competitive bracket go up?
Yes, that is correct. Occasionally, the interest might not go up, but the gearing might go down.
What is the gearing?
The gearing is the level of debt against the value of the asset. So in development finance world, the gearing that people usually refer to is the loan to GDV. Mm-hmm. So the loan amount relative to the GDV of the project. Very standard loan to GDV is 65%. So majority of the players will go to 65% very comfortably. Very few players will go to 70%. So the example I used previously was a 70% loan to GDV, but this is very limited proposition because this is treated as stretched senior debt. And some players suggest that they may go over 70, but that's a very rare occurrence. And yes, as you move from high street lenders to bank lenders and the non-bank lenders and the challengers and the family offices, the interest rate would typically go up, but so would the speed, the agility, the commercial views, the customer service. There's a price to pay.
I see. The 65% loan to GDV ratio. So say if you're building an apartment block and it's all 1 and 2 beds, that's going to have a higher GDV than the same block with the same massing, but it's all 3 beds.
That's correct.
And so the notional optimization of GDV on that site is going to be lower for a policy compliance scheme than if you just built the most profitable thing possible in that envelope.
You're thinking the planning policy requirements are not aligned with the aim to maximize GDV, or they're not working in favor of the borrower.
Yeah. Well, and that's fine, right? It's okay for planning policy to want to rein in a market instinct because that's what effective regulation is going to do. It's going to put guardrails and limitations on a market. Every time that the unit mix needs to be adjusted away from a more profitable floor space, every time that a story needs to be deleted from proposed plans, that's reducing the GDV, while at the same time we see macro forces increasing the build costs. And the build costs for that apartment block might be really similar for all 3 beds versus a whole bunch of 1 beds. And so we've got planning on one side kind of curtailing GDV, which it should, but maybe not as much as it does. And then on the other side, you've got the actual loan, which needs to cover the build costs, which are increasing, but only a certain ratio kind of works in the sweet spot, like that 65%.
Yes, by the time the finance is approved, you have full visibility of your final planning approval. So you know what your GDV is going to be. You wouldn't have loan approved and you wouldn't start construction and then the planning will change later on. And I think I know what you're thinking. When you're trying to obtain planning, the borrower's aim is to get an optimal GDV within the envelope permitted by that planning.
Yeah.
And as we know, the smaller the units are, the higher pound per square foot you can achieve for those units, while the construction costs are broadly comparable between the units containing small units mainly, or between the good mix. Of course, there's a bit of bathrooms and kitchens cost, but it's not significant. So if it was down to developers, they would always try to deliver as many smaller units as possible within reason, as long as they're still liquid. And naturally, a good mix of 1 and 2 beds and maybe some studios is an optimal solution, because once you go into 3-bed units, they will then start competing with houses in the vicinity. And the big question mark is, who's going to buy a 3-bed flat when they could have a house for the same amount?
And have a yard, yeah.
And the larger the unit is, the lower pump per square foot for GDV purposes is, while the construction costs are the same irrespective of whether it's a 1-bed or 3-bed. So the developer's desire would always be have a good mix of units, but priority is for smaller units because they will achieve higher pump per square foot, which will maximize return.
It would be really interesting, I think, to explore this further with documents like the London plan or a development plan anywhere, to understand the specific interplay between the ability to secure finance and the planning policies themselves. So really any planning policy like unit mix that actually does have a very direct impact on GDV, which then will change your ability to get to that 65% sweet spot.
The challenge is when the GDV is not significantly higher than the cost needed to deliver the project. Right. Because every lender's priority is to fully fund the scheme. So the focus is always on interest and construction costs. And in particular, outside of London, if your GDV doesn't add enough value to the project and you barely have a slither of profit on top of the construction cost, those are the projects where you would often need to bring significant amount of money to even be able to access development finance. And those are the projects that are becoming illiquid. You cannot get your finance on land with planning, even if it's full planning. You need to bring significant amount of money to even begin the project and begin the finance. Those are the ones that are locked out. They become viable projects, as in they will generate profit, but because you need to bring so much money to even start those projects, they often don't lift off the ground. This is where the value of GDV and value of planning tweaks and enhancement is essential in order to even begin to think about delivering those projects to the market.
So if a developer doesn't want to need to pay anything out of their own pocket to make the development happen, and we're looking at the 65% loan to GDV ratio, then to fully finance a scheme, it needs to be about 50% more valuable than the actual cost that goes into it.
It's not, there used to be a belief that it's a third principle, but it doesn't really work. It has never worked. I don't even know where the Fairytale came from, if I'm honest. There is old belief that in any development project, a third of it goes towards land, third of it is construction cost, and third of it is profit. It's a fairy tale. It does not exist. You can use it as a tagline.
There are a lot of fairy tales in planning.
But going back to what you just said, developer will always put cash in the deal. It's actually minimum requirement from the lenders. But the question is how much cash, and the optimally designed project is where you're able to obtain full funding for full construction costs and professional fees and contingencies and Section 106 and seal and marketing, etc. So the project is fully funded in terms of construction. The project has got enough room to accommodate full interest payment, and there is enough left to offer a land advance. Because those structures then allow the borrower to input minimum amount of cash necessary, and that will range between 10 to 15% loan to cost, and that allows the borrower to unlock sites. Those are the optimal. If you think about optimal planning, that is exactly a good example of optimal planning. Unfortunately, in particular in the recent years, due to various reasons and political uncertainty in one of them, inflation going up, cost of living, high finance costs, high interest rates, PSA 2022, planning becoming more difficult, PNG requirements, all of those are becoming more and more onerous, more and more difficult. Some developers give up and leave the space because the profit margins in construction, in development are not high to start with. Majority of the players would operate at, in best case scenario, 20-25% profit on cost. But those profit and costs get wiped out quite quickly if you have inflation while you're building, if your interests go up while you're building, if your labor leaves because of Brexit, or your budget keeps everyone nervous and your sales are not proceeding because the interest rate is too high, or people are nervous, or money is leaving the country. Unfortunately, only more sophisticated or well-capitalized developers are staying. Those who are still prepared to take the risk for very little reward, if I'm honest. That's not good news, and that obviously goes way against the big plans of 1.5 million new homes delivered. It's becoming a joke. It's become a laughing joke in the industry. We all say the number and we all laugh in the professional rooms.
Laugh to keep from crying.
Yeah.
It's been really interesting actually watching the discourse around the 1.5 million homes, because it started with, oh, but I do have my reservations about whether that 1.5 million, oh, but I'm really not sure. Well, anyway, so they say that's the case. It's never going to happen. And it just declined and declined over the past year and a half. Everyone's like, oh, okay, yeah, we see what reforms are being implemented. We know that's not going to get us there.
No, we're going in the opposite direction. Can we finish on a high?
Yes. Yes. If we were to remember that we have agency in the direction we're going to head, how do we get to somewhere that's more positive for the society, for the sector?
The 2026 is actually a little bit more optimistic than 2025.
This is our year.
This is our year, yes.
Okay.
The reason it's a bit more optimistic is we had some turmoils last year. We had quite significant political uncertainty. Mm-hmm. We had relatively high interest rates, which are, in perspective, they're not high, but relative to the interest rates we enjoyed for the last decade and a half, they are high. And it's a bit of a shock rather than the genuine increase in finance. It is increase in finance costs, but it's a relative increase. But what has been happening in the last few months, and the sentiment is palatable in the industry, the interest rates have relatively stabilized and have been going a little bit down, and there is a bit more talk about them continuing to go down. The budget is over and we have had no disasters in that budget. There were a few annoying bits and pieces, but it wasn't as bad as everyone thought or predicted or worried. And everyone who put all the plans on hold actually came back to the market now going ahead with the original plans they had, whether it's construction or purchase or buying new homes. The labor and construction costs are relatively stable, and having a stable component within the equation, it's always a good thing for developers in particular. So the interest is going down, the labor and materials are stable. The uncertainty we still have, but I think we're already seeing signs of improvement, is the ability to sell the completed units.
I see.
Because that's always a challenge. You can go ahead and you can get planning and you can get viable scheme and you can get development finance. And as we said, development finance is great and there's plenty of offering and it's very competitive market, it's well catered for. But when you finished your project, if you're unable to sell your units, your equity stays locked in that particular project, meaning you cannot go ahead and buy the next one and the next one and the next one. You need to sell the units to release that cash, to release the profits, and then go to the next one. So as soon as those units start selling, as soon as the buyer's market comes back in, the first-time buyers, the home movers, the investors, that will bring a lot more optimism and a lot more activity into the market. But even without that happening, which I think it is happening already, even without that, as long as developers can foresee the velocity of sales, the prediction around sales, and the length of time it will take them to sell, they can plan and they can calculate the viabilities, they can bid on land appropriately, they can still maintain profit margins into those projects. So that stability, relative stability, is key to unlock construction and development finance and development provision.
What do you think is necessary to actually return to a strong level of buyer interest or a relatively speedy pace of disposal for properties?
Finance cost.
Back to that baseline interest rate.
It is already helping, and the expectation of this reducing further really does help people to take that step and to go into the first purchase or the investment. It plays significant parts in decision. Employment levels, when people are confident in their employment, they're more likely to go and buy assets.
Mm-hmm. Yeah, I can see both of those helping. It's difficult to think about this in sort of social equity terms and in financial terms, strictly speaking, because flats are also going to be so expensive, even with low interest rates and favorable sort of certainty and optimistic in the market generally. But how broad a swath of society is that when we're talking about the people who could buy a new build if the conditions were more favorable, but can't just at this moment?
I think when you look at rental payments and you compare them to mortgage payments, for many people, many families out there, the mortgage payments are actually lower than the rental payments. So it makes perfect sense for them to buy. then it all comes down to whether they have enough deposit and whether the interest cover ratio is met when it comes to obtaining home mortgages. The home mortgages market have been improving and the interest to income ratios have actually been stretched in recent years. So it's becoming more accessible. And if you look at capital growth in the recent years, actually last year in 2025, in real terms, the capital values went down, which means in real terms, taking into account inflation, those homes became more affordable. We don't feel it this way because we don't think of inflation as a player, but it is a significant player.
Yeah.
So then it all comes down to whether those people can gain enough deposits, whether it's by using family money, mom and dad's bank, or gearing up against using the mortgages. For many people, when they look at level of debt needed to buy their own property, it's very scary. Having said that, if the economy is relatively stable and they have job security, this is the right thing to do for them because as we know, those assets will only appreciate in value over time, and you would normally sit and keep these assets for long enough for it to appreciate, while your debt isn't going to appreciate. The debt is a nominal figure.
Yeah.
Assuming it's not linked to inflation, which it isn't in this country.
And your rent check is just burning money. It's a guaranteed 0% rate of return.
It is, and it's only going to get worse.
Yeah.
Obviously, there's a big blue dream around another help to buy. But I think if we were to introduce another help to buy, it really need to be thought through to prevent it from creating a two-tiered market, which is quite harmful.
How would that look? How would a help to buy scheme or some sort of demand side intervention look if we wanted to make sure that it didn't have an inflationary effect on sales prices? It's hard to see the seller's side of the market not responding to the fact that the buyer side has more money on the table.
The previous help to buy was limited to new builds only, and it was targeted at specific capital value of the purchased units. If the new one was not linked to new build, but it was focused on first-time buyers, allowing them to buy any property, yes, it will potentially cause inflation linked to capital values of the stock, whether it's a new build stock or second-hand stock, but the benefit of unlocking the buying power, in my opinion, will outweigh the inflation or the temporary inflation.
Okay, so there are ways to look at it where that inflationary effect is accepted as a sort of given component of that kind of approach, but that the benefits are still greater than the cost that creates.
I think so, because imagine all of those first-time buyers who are missing just a little bit, just another 20, 30, 40K to help them to make that move.
Just a little bit, 30, 40,000 pounds.
On a bigger scale, I think it's not a significant amount of money. And if that's what they need to take them over the line, that could really spice up the market. And remember, the first-time buyers, they're not buying £2-3 million mansions. They're buying flats or maybe small houses.
I think that's a high note. I mean, I'm more optimistic than at the end of the previous segment. But no, I think that those are also all marginal, incremental, reasonable changes that we could certainly look forward to and maybe even reasonably expect to the next few years.
Fingers crossed.
Fingers crossed. Uliana, thank you so much for joining us today.
Thank you for having me.
Absolute pleasure.
Thank you for joining us for another episode of Make Planning Make Sense. Please do give the show a follow and please share the show to keep the conversation going and the community growing. Find us on Instagram, X, and Blue Sky at MPMS Podcast, or write to us at podcast@centroplan.co.uk. Make Planning Make Sense is presented by Centro Planning Consultancy and recorded in beautiful London, England. Its executive producer is me, Aaron Zimmerman. Marketing and promotion by our colleague Reese Raymond. Graphic design by our colleague Miriam Malaxi. Music by Joseph McDade. From all of us here at Centro, thanks again for listening.